And it just so happens that I have a dark wall behind me with nothing on it. So that's the only reason I'm able to do it. I understand anyway. So
looks a lot warmer in Halifax right now.
Yeah, it does, doesn't
it? That's where you are right now, Chris?
Yeah, I'm in Halifax. Yeah,
that's right.
Yeah.
So we'll just wait a few more minutes here for a few other people. It's not quite 1:15. Probably wait till about maybe 1:16 or so, and then we'll get started.
Sure. How are you guys doing?
I'm pretty good. Certainly some interesting times. Working from home, and I live in about an 800 square foot apartment, so sometimes you're kind of all over each other in a small environment like that. But no, outside of that, I'm doing okay. And Paul, how about you?
Yeah, same thing. My house is a bit bigger, but I've got 2 7-year-old boys, so I'm sure it feels smaller than your place, Trevor. We thank goodness for a trampoline in the backyard. Otherwise, all our furniture would be done.
And how's the mic check? Paul, you can hear me okay?
You've got the ability to mute everybody, right? I think I saw you did that.
Yeah, so I've got everybody on entrance. Everybody's muted, and so what we'll do here, Chris, Paul, and I will just kind of moderate, host the call. If anybody's got any questions at any time, go ahead and enter them in the chat. And what we'll do, Paul and I will kind of just go over the business with you, and then start getting into some of the questions that we've got. And if we get any questions from the subscribers, we'll directly ask you, Chris. And after the call, I'll provide you with a list of the subscribers who are actually on the call today too.
Sure, sounds good.
Okay, cool. So why don't we start it off, just because I'm sure that not everybody is familiar with Nova Leap. Why don't you give us sort of a 5-minute kind of breakdown and overview of what it is you guys do?
Yeah, so Nova Leap Health Corp's traded on the Venture Exchange. We're in the home care services business. So primarily, we're looking after senior people within their home. So I often contrast that to, a nursing facility or assisted living facility. We're not in that space. We may provide some one-on-one care for folks that have dementia within facilities, but really we operate it predominantly, in home care. We run what's called a private pay model. Some people refer to it as, non-medical. And so that means about 85% of our revenue is pure private pay. The other 15% will be a combination of, veteran affairs or long-term care insurance. Our head office is based in Halifax. We have operations in Nova Scotia as well as 6 states in the U.S. And so we operate in Vermont, New Hampshire, Massachusetts, Rhode Island, Oklahoma, and most recently we just announced our first foray into the Buckeye State in Ohio. And so majority of our business would be in the U.S. Probably about 2/3 of business, upwards to even 3/4, depending. But that's about. That's our business in home care, private pay models are not really impacted by Medicare or Medicaid for those that have invested in some of the smaller healthcare companies in Canada and US on the venture exchange that have had exposure to those. So again, mostly a private pay business.
Okay, appreciate that. Paul, do you want to jump in with some questions right away?
Yeah. So big part of your strategy is M&A. Maybe spend some time telling the audience what you're looking for, geographically, where you're starting to accumulate companies, and then, ideally where the synergies in, or let's call it the benefits of this kind of strategy.
Yeah, so if I sort of go back a couple of years, so we in 2016 we went through the CPC program, and so we started with a clean shell, and since the latter part of 2017 we've been fairly active in making acquisitions. So it's definitely a roll-up strategy. We've made acquisitions. We started primarily in New England, and so we went into Rhode Island, and then Vermont and New Hampshire, and in Massachusetts. So in 2017, we made 2 acquisitions at the tail end of the year. In 2018, we made 5 acquisitions. And in 2019, we made 3. So again, mostly New England based, some in Nova Scotia. And then last year we went into Oklahoma. So the premise behind it is really, we're looking at a very fragmented market. There's thousands of these small mom and pop businesses that are around, and my vision was really we could take we could buy these small companies at a good multiple, put some operational efficiencies in place, bring a dimension of focus to bear the companies. And then over time, as we scaled up, we'd see some greater efficiencies by consolidating back office functions, utilizing technology, particularly around our scheduling software, which ties into billing and payroll and accounting functions. And so that's what we've been doing. And so the first couple of years we spent building a bit of a regional platform in New England. That worked out very, very well. And for those that have, if you were to go back and sort of look at our quarterly results, you'd see improvements in gross margin and EBITDA margin and so on, operational cash flow. So that was why we made the decision last year to go outside of New England. And so we went to Oklahoma, so Central. I think it's a good region for us to expand. But when we take a look at the actual businesses that we're buying, they're pretty small. I think our average revenue acquisition, I think it's been about $1.8 million. They're generally they've been anywhere from $1 million to I think 3.2. So we're talking about really, really small, tiny businesses. But again, as we put them together, what we're doing is we're taking, occasionally we're buying out a competitor. We're taking one manager that's a top performer at one of our agencies, and then, we give her a second agency and sometimes a third. And so we start to get this sort of common management system in place, and then common systems and processes and so on. And so that's really a bit of our strategy. We buy these businesses generally between 3.5, 5 times EBITDA, fairly consistently. And the manners in which we finance them have really been some cash on closing, vendor takebacks or promissory notes, seller notes, whatever you want to refer to them as. And then Bank Montreal has been a great partner for us. And so where we've asked for bank financing, that they've been able to provide it, usually amortized over 5 to 7 years. And in one case, we did issue stock at a treasury where we had a sophisticated seller. And in one other case, we did issue an earnout structure for Oklahoma. So again, small businesses, small revenue base, putting them all together under common management, buying them at a fairly attractive multiples, and then bringing fairly consistent types of financing to bear in these cases, because they are cash flow positive businesses, historically cash flow positive, and so we can leverage as we go into these new locations.
Mm-hmm.
So
how competitive is how many other buyers are you facing when you look at these, or are you typically the only buyer?
Yeah, interesting. I mean, because we're buying, businesses that are so tiny, we tend not to come up against, private equity players or, large public companies. Matter of fact, some of the larger public companies have said that it's very difficult for them to do deals like that. So that's been great for us because we can consolidate and become attractive to them at some point down the road. But I think we're really competing against, high net worth individuals or other individuals that are looking to buy one standalone location. And that tends to be what they are, right? Where we buy a business that's been around, 10 or 15 years. It's operated within a fairly restricted geography. It's not really, that particular owner has not looked to grow it beyond that geography. He or she's been quite happy with that. So I think we're competing against individuals for the most part. Occasionally, we might come up against a franchise or that's looking to convert an independent company into a franchise, but I haven't seen a lot of that. So mostly individuals.
Trevor, you were going to say something?
Yeah, I mean, you're acquiring all these, smaller businesses with, revenues around the $1 million range. Given that you guys have gone from, 0 sales to around 17 million yourself, is that sliding bar of companies you're after? Is it getting larger? Or can you start going after, companies with 5 million in sales? Is that something you guys are looking to do eventually, or?
Yeah, so a couple things. One is the $1 million is at the low end. I think we bought one business that was $1 million, and we report in US dollars. So if you look at our financials, again, it's US dollars. So when I talk about the revenue base, that's what I'm referring to as a US dollar denomination. Yeah, sure. We've looked at opportunities that are larger than that. So I think there's two things to consider. One, we can acquire more businesses in a given year. Again, we've averaged 4 acquisitions the last 2 years, but we could acquire more if we saw the right opportunities. We can open new locations as part of our expansion strategy. We just did that for the first one in Ohio. But yeah, we could absolutely buy or acquire larger businesses. And again, we've looked at those. Just I haven't been able to come to the right valuation that would fit within what we're looking for.
Okay. And speaking of valuation at this, kind of interesting time, is the landscape shifting at all right now, given, COVID impacts? Are things getting cheaper? Are there less opportunities, more opportunities? Maybe you could sort of speak to that.
I think it's too early to tell. I mean, I think we had our board meeting on March 12th, maybe March 13th. I can't remember the exact date. And, here we are, we're a month later. We've seen a number of businesses that are mostly franchises come on the market. So we know they're coming on the market, but we're not interested in the franchise model. I tend to look at it from two ends of the spectrum. I think on the one hand, given some of the legislation that has come out in the US, and given the potential market dynamics, you could have some people that are getting squeezed out. And so maybe they're forced to sell because they don't have the cash to be able to withstand, the current market conditions. Then on the other hand, you look at that and say, we have all these individuals that are in facility settings, nursing homes, assisted living. And, given what's happening within, North America, if you just take that as a standalone, I mean, who wants to put mom or dad in a facility right now? You can't see them. That if COVID-19 gets into a facility, it's going to run rampant. So pretty difficult situation. So, we've had people call us to try to get mom or dad out of a facility and let us take care of them at home. So if you're an owner, then really I think what you're weighing, if you were to sell your business, you're weighing, should I wait, thinking that the market for independent home care businesses is going to be even greater sort of mid to long term, given the current dynamics, or do I have to sell because maybe there's pressure on the business that I didn't have before? So I think you have two ends of the spectrum. Where that ends up, I don't know, but I don't see valuation shifting that much. I certainly have no inclination at this point. But again, I think you'll have some good buying opportunities on the lower end, and others that'll take a position that their business is worth that much more.
Cool. Appreciate that. And, as far as your guys' operations right now, obviously a lot of investors are trying to figure out, which companies are thriving or, relatively managing well throughout this time. Could you maybe speak to the impacts of COVID on your business and how you guys are moving forward?
Yeah, look, I mean, I think I've come out in the last couple of press releases to say, I feel we're in a pretty good situation. We just came off a capital raise at the tail end of last year. I look around a lot of the industries that are significantly impacted by this, and some are completely shut down. We're considered an essential business in every area in which we operate. So, I take that as a positive. So all of our businesses are operating as they have in the past. Whether our agencies are increasing in revenue or decreasing, we're just coming off a March 31st quarter end, so I'm not in a position to talk about that until our results are issued, I think, about a month's time, probably the second week of May. But again, I'll reiterate what I've said the last couple of press releases, which is I feel very comfortable with where we are as a company, and that's not changed. The one thing I'll say is this: if you ever want to test or find out whether or not the operators that you have, the businesses, are good operators, put them through a pandemic. So I know that's not by choice, but I can tell you just how comfortable I am with the operators that we have in Massachusetts, Vermont, New Hampshire, Oklahoma, Rhode Island, and Nova Scotia. It's really reinforced the fact that I'm pretty confident we have the right people in place. So again, not sort of picking up a pandemic by choice, but the one thing I'll say to this group is I'm very, very comfortable with who we have operating our businesses.
Now, Chris, procedurally, are there anything that you've had to change in how your business functions right now? Yeah, I mean, I can imagine there's a lot of issues around health and your clients and staff, but functionally, what have you guys had to change to operate right now?
Yeah, a couple of weeks ago, it started to get pretty intense just in terms of what the requirements are. So again, we think about we're operating 6 states, a province, 2 countries. So we're looking at Health Canada when we think about our Canadian operations. We're looking at the CDC. we do pay attention to the World Health Organization, notwithstanding they may be defunded by the U.S. And there's, you know, state specific laws and sometimes county laws, although you'd be more like in Florida before those be applicable. But, you know, there's been changing legislation, for example, around masks, right? So before it was, you don't need to wear a mask, right? And now maybe you do need to wear a mask. So for example, Nova Scotia, what they just put out was, if you were in long-term care, or if you're a home care agency, then all of your caregivers have a requirement to wear a mask when they provide care. So, you know, that requirement didn't exist, well, 3 days ago. It just came into place a couple of days ago, right? So, you know, fortunately we have PPE, but, you know, us ordering more PPE obviously is different than what we've had to do in the past, right? So, to give you an example, I think I have put this up here. So, you know, here's a mask right now, right? So just kind of goes over the back of your head, right? Goes like this. Now that's a shield. So let me just clarify. We have those in case we ever come into a situation where we need them, but you don't need a shield unless you're looking after someone that's COVID positive, or if we're doing work within a facility. Some of the facilities have a requirement that all individuals providing care have to wear full PPE, just as a precaution, not necessarily because there's someone positive, but just as a precaution. Mm-hmm. So I think the sort of the you know, so the sourcing the PPE, you know, the change in requirements that may exist at a state level following that's been sort of one dynamic that's changed a little bit. Now again, we're primarily non-medical, so we're certainly not impacted like, you know, Medicare type companies are providing skilled nursing, like significant difference. So I don't want to lead anyone down a path thinking that, you know, we have to have everybody wearing this at all times. That's not the case. But that's been one aspect. The other aspect I would say has been the changing legislation, and just keeping on top of, you know, the changing legislation, for example, in Canada and the U.S., particularly in the U.S., there's two different acts that have come into place: the CARES Act and FFCRA. These are, you know, acts that could have an impact where, you know, an individual's been impacted by COVID, right? You know, what happens if you have a family member, we're providing care to someone, and maybe they have a family member that has a symptom, right? One of the symptoms, you know, what do you do in that case? The requirements or the guidance is different in Canada is in the US, right? So if you have exposure, you've got to self-isolate in Canada for 14 days, and then you can go back in. In the US, it's different. In the US, the epidemiologist would say, you're fine as long as you haven't been within 6 feet of someone for more than 15 minutes with no PPE, right? So that's a different requirement than what they would say in Canada. And so, again, just I'd stay between making sure that we have enough supplies for PPE and just following sort of the changes in legislation that are coming out between both countries. That's been a bit of a change, you know, in the business for the last little bit.
And then I want to ask you again, you touched on it, but so you are starting to see at least an increase in inquiries about, you know, taking patients, taking called parents out of facilities and more to home care. That was one of my real serious questions I wanted to figure out is, are you seeing a positive impact business-wise from what's going on right now?
Yeah, so we've had inquiries, and we've certainly had we've taken clients out of facilities. Now, what most states and most provinces are saying is they're not trying to get families to do that. They actually want them to stay in place because they don't want them traveling from one spot to another for fear of spread. But yeah, we've certainly fielded calls and have taken on new clients. You know, what impact that'll have on our business long term, I mean, that remains to be seen. But yeah, certainly there's been an increase in those types of calls specifically as a result of COVID.
Okay, good. Again, you touched on it a little bit before, but give us a sense of the market you're in right now, the different geographical areas. How much opportunity do you see within there, either through M&A or just you know, your organic growth that you see right now?
Yeah, start in Canada. So in Nova Scotia, there's still opportunities to expand within Nova Scotia for sure. We're really in 3 locations at the moment, and so there definitely there's more room for either M&A or organic growth within Nova Scotia. Within Vermont and New Hampshire, there's organic growth opportunities, maybe some at M&A. So if I look at sort of broadly through New England, there's still organic sort of new office location openings. I can touch upon what that looks like in a minute if you want, but there's sort of that aspect as well as M&A. I think there's lots of opportunities within New England, and probably more so on the M&A side within, say, Massachusetts. I would think just a larger state. We haven't even entered into Connecticut at this point. South Central is ripe for us. I mean, we've made one acquisition thus far, small little business, and so we're looking at other opportunities there now. So I think there's a ton of room for both M&A and organic expansion in all the areas that we're in.
Fantastic. Now I noticed that you guys are, now it's not necessarily you're branching into it, but you're starting to give more service around dementia and sort of dementia care. Can you maybe explain some of the services that you offer your clients?
Yeah, so I mean, dementia care really comes from our first family experience. My father-in-law was diagnosed with Parkinson's years ago, and we've seen him deteriorate. And so what we saw when my mother-in-law had a home care for him really was that we had really, really nice caregivers that were coming in, but they hadn't been properly trained to deal with somebody who had dementia. Like they were missing some techniques that I think would have been quite valuable. And quite honestly, had I known the techniques at the time, I mean, I could have been in a better position to help. And so we've invested in a program out of the U.S. Called the Positive Approach to Care. And so when we look at all these agencies, if you go on their website, they all look the same. They really do. I don't see a whole lot of differences. They all say they provide dementia care, and they would provide care to somebody who has dementia. The difference is, we're sending our senior people to take this specific training. They have to come back. They have to video themselves training our caregivers. That video gets assessed, and there's ongoing dialogue before they receive a certificate. And so all of our caregivers receive paid dementia training. And these are skills and training that they've never received in the past. So we are investing in dementia training for all of our staff. It's been a key component of our growth. It'll continue to be very important to us, but it's just one of the things that I thought, again, from family experience, it's some very simple things that can be done that are quite valuable for the families. And I've seen it in person, and so we just thought it was valuable to roll out across the organization. And we are either in the process of doing that for newer locations where we've made acquisitions, or we've already done that. And so it's really around that particular training program.
So are there any other services that you guys offer that makes you a little bit different than your competitors?
No, look, this highly competitive space. I mean, I'm not going to sit here and say that we're doing a lot of different things different. I mean, it comes down to the people like any other business. I think we have great people. The dementia training is certainly different. We've gone up against others when we're meeting with families, but there's lots of other companies out there that are doing this. Talk about the moat around the business. For us, it's really the scale of the business that we get, the consolidation of the back office functions, and just making things a little bit more efficient. So, whether it's a franchise or us within a particular area, I think you have two companies that can provide a similar type of service. Again, I think the one that stands at the end of the day is the ones that invested in their people, and I think we've done a good job of that.
Fantastic. Okay, so you guys grew your business quite nicely last year. I've got 17.4 million versus 10.4. Can you break down a little bit how much is organic growth? I mentioned the bulk of that is M&A growth, but what kind of organic growth do you see, if any, of significance? What can you tell us there?
Yeah, most of that would be M&A growth. I don't think we've ever broken down publicly at the top line. What we have done is we've broken down, I think, the gross margin, organic gross margin, and EBITDA. I'm not sure we did that for Q4 for the end of the year. I think the numbers we had were Q3, the last one. So I'll be cautious on that. I think up to the end of Q3, we had organic sort of service margin. So think about we charge per hour, then we pay our caregivers per hour, so we make margin. And they're for those interested in the U.S., they're W-2 employees or T4 employees in Canada, so they're not contractors or employees, which is a big distinction in the U.S. from the Department of Labor's perspective. So we did grow the margin, I think around 10%, and I can't remember the exact number for EBITDA, but it was at one point it was up 64% or something. But so there's quite substantial from a improvement in cash flow from the point after which we've taken over these organizations. What it'll be going forward from an organic growth perspective, it's hard to say. It's a function of a couple things. One is when we go into a particular area, where does the business stand from a building perspective? And so, I always say that a perfect business for us is an imperfect business. So maybe we have the ability to move the building rates up to what I consider to be a market rate. Maybe the current owner is not managing overtime as well as he or she should. Maybe the staffing model is not appropriate. Maybe there's no marketing. So a whole bunch of things that go into every business. But I think you'll continue to see the industry itself. I think has been growing when you factor in Medicare, Medicaid, 7% or so. So, to me, it's a single digit type of industry going forward. I don't see that changing a lot. Where I do see from our perspective is a difference where, in the past, we go back to sort of 2017, we were always, make an acquisition, announce an acquisition, do a private placement, and so on. We've really gotten away from that. And I think the point where, we've reported some pretty good, again, tiny business, but some pretty good operating cash flow. Then we have the ability to sort of reinvest in new locations and new acquisitions. At the same time, our debt's coming down quite significantly. Particularly this year, we're paying off pretty much the remainder of our promissory notes. So again, I think we're in pretty good shape going forward.
So just sorry to interject there, Paul, but touching in on that organic growth side, are you getting pretty good ROI out of expansion from an organic side, in the sense that, like, you open up a new location in Ohio, wasn't an acquisition? Like, what are some of the ROI metrics like for that?
Just for a standalone operation?
Yeah, as opposed to acquiring another company.
Yeah, I think they're significant. So the way I would look at that is again, key thing here is to hire a really, really solid person from the get-go. Otherwise, you're going to have a huge expense. But you're hiring one person. You have a small rented footprint. So think about sort of salary and rent. You got some marketing and so on. But you could sort of go probably 18 months, 24 months to hit break even. That's what I would estimate is a reasonable target to get to break even for a new standalone location. And you might have to put in $50,000 to $75,000 of cash, depending on how it's sort of ramped up. So let's take 75, or even be more conservative and say it's $100,000. So you put in $100,000 to start a new location, your break even, hopefully by the end of year 2, and then it's just free cash flow after that. So, you could be doing by the end of year 3, you could be doing, $120,000 of EBITDA. So, obviously the returns are quite compelling if you can do it right.
Cool. What's your current run rate revenue? Are you able to tell us that with the last couple acquisitions?
I could tell you just to take the Q4 numbers and multiply by 4.
Okay, we can do that.
That's probably the best I can tell you at this point.
Gotcha. Okay, fair enough. And your margins, your gross margins came in around 33.5% for 2019. What can we expect going forward? What kind of improvements, if any, can you make on that? I mean, we're probably talking a couple percentage points at best.
I think gross margin is going to be fairly consistent. You sort of look back. I mean, I think a couple of years ago we might have been around 32, low 33. It went as high as 34 something, during one quarter. But it's improved a little bit, but not to the point where it's sort of been too 200 basis points or 2%. So, if I were an investor, I'd continue to use sort of existing metrics. I have no reason to believe at this point it's going to change a whole lot. Again, we go into different states. Can we improve the billing rate? Sure. Could we reduce overtime? Sure. And so we'll likely continue to improve billing rates, but you also have minimum wage requirements too, depending on the state. And so, again, if I was an investor, I'd probably just use the consistent numbers. I think that's reasonable.
Right. And then, sort of speaking about some of the metrics you guys have for a business, Chris, what type of internal metrics or KPIs are you guys sort of measuring yourself internally off of?
Yeah. So, I mean, we track this with our operators every month. I mean, obviously we're looking at, revenue growth, our gross margin percentage, management overtime, billing rates. But our primary runs are revenue, gross margin, and EBITDA, just from a monthly reporting perspective, which are obviously driven by hours. And so it's something that we pay attention to on a weekly basis. As well as aged receivables and collections. I'll talk about that just in a second. And then again, just taking a look at operational cash flow, and then how we can generate higher returns on invested cash. And so my definition of return on invested capital is probably slightly different than the sort of typical definition, which includes debt. Because if we're paying off debt fairly quickly, it's over 5 years generally, right? And so if you have debt as part of your invested capital, then all of a sudden the year in which you pay it off, there's a sort of a massive jump in the return, the way I calculate. So I tend to not. I like debt, right? Lots of people tell me they hate debt for nano cap companies. That's fine, your own opinion. I like it. We have good cash flow companies we can leverage. To me, that's a good tool to use, and so we'll continue to use it. So I don't really envision a time where we're never going to have debt on our balance sheet. It's not the way I operate. I'm comfortable with it. If I may, though, just come back to collections for a second, because a question I get all the time, so I imagine it'll be here, is, how good are your collections? I'll just refer you to our last two press releases on our annual results. I think, Paul, you referenced, I think it was 10.4 million in U.S. in revenue for 2018. We had less than $1,000 in bad debts. Pretty extraordinary. Last year we had over 17 million U.S. in revenue, and we had roughly $35,000 in bad debts. Again, I think those are exceptional numbers. And so certainly within our history, we've demonstrated our ability to collect. What impact will COVID have? I don't know. If I were an investor, I'd probably think that there's probably some greater uncertainty of collection. I personally haven't seen that, but it's something that certainly we're looking at very closely. But I really haven't seen huge changes from how we've operated or collected in the past versus how things are going now. So.
No, thanks. Thanks for answering that question before I asked it. It's just over 65 million shares outstanding. Is that correct?
Yep.
Okay, and break down the insider ownership.
Yeah, so 38% insider ownership.
Yep. Okay, and how much of that is you directly?
12%.
12%. Okay, good. And maybe at this point, because M&A is such an important part of your business, why don't you give us a little bit more background? Before you got involved in this business, what did you do, and how does that play into the skill set needed here?
Yeah, so I'm a chartered accountant by background, I'm a CPA now, I guess. I worked at Grant Thornton for a number of years, about 7.5 years, and then I worked with BMO Harris Private Banking. I ran a couple divisions within Atlantic Canada for 5 years. I then set out on my own. I started my own private capital markets investment bank, so I was doing mostly buy-side advisory work. So essentially working with companies looking to make acquisitions. So I would approach a target. I would negotiate the deal on behalf of my client. I would arrange for financing and help with due diligence. So, I have a transactional type background and I've been doing quite a bit of that prior to starting Nova Leap. And so I probably did about $350 million, whether it be private equity, sponsored transactions, or larger sort of Atlantic Canadian based companies. So I do have a transaction background as well as a financing background. So sort of parlayed both of those into some of the activities we're doing with Nova Leap Health Corp.
Mhm. I think at this point, we should mention that for those listeners, you guys, if you want to start asking questions, just enter them into the chat. In a few minutes, we'll start asking Chris these questions. So Chris, if you mentioned financing, what if anything should an investor either watch out for or take note as far as any future financing requirements? You guys just did a financing, I think, at the end of last year. What do you think your capital requirements are going forward?
Yeah, so we did do so maybe I'll touch upon a couple of things. I'll touch upon our balance sheet and then the financing if I can. And so I think in one of my more recent press releases, I sort of talked about our debt, right? So we have $1 million Canadian operating facility with one of the banks, which has been unutilized. We have, if you were to look at our balance sheet today, you'd see these sort of demand loans. And again, I try to clarify, there's some confusion around that. We're going through our regular sort of D&O insurance application. And one of the questions came, how are you going to pay back this demand loan? Well, it doesn't work that way, right? So we have a current liability, which is a demand loan, but it's amortized over 5 to 7 years. So we make payments on that just like a term loan. So principal and interest every month. And so we're really paying that back. I think one facility is over just over 2 years, and the rest are sort of between 2 to 5 years, right? So if you see the demand loan, there is no requirement to pay that off by the end of 2020. That's not the way it works. And then we have some promissory notes, which are the seller notes, which will be paid off at the end of the year. Majority will be paid off at the end of the year. We have an earnout I think will show up, and then we have the convertible debt. So the convertible debt, we raised just over $3 million Canadian. I think we closed that mid-January. That was the first financing we'd done in 14 months. And so we don't have a pressing need for financing at this point. I'm not, I'm at the point where I'm quite happy not to do financings. Obviously if we saw the right opportunity or opportunities in combination, could we do one? Sure. I'm not going to say we'll never dilute, but we're actually at the point where we don't necessarily have to, right? It's by choice. And so hopefully investors will take comfort knowing that I have a significant amount of money into the company myself. I like to keep it that way in terms of not diluting. We'll do it only if it ever made sense. But this is long-term for us. And I maybe that point needs to be reinforced here because we're playing the long game. I can tell you after, the number of meetings I've had with, investment managers over the course of the last 2 to 3 years, and, the reference to, the vulture exchange and everything else, this is not short-term by any means. I keep telling people that at a 10-year plan that's a start, and 5 years from now, it'll sure be another 10 years. So I plan on being in this chair for a long, long time. Again, significant skin in the game on my own. And so we're not in a rush, which I think is we have patience to be able to buy these companies at a good valuation. We've passed on big businesses because valuations were insane, didn't make sense for us. And so we're not making acquisitions for the sake of making acquisitions. So I think that if there's one thing I could sort of reiterate to investors here is that, we do look at these acquisitions from a perpetual perspective, right? Like we're not looking to get in this to flip. People ask me what the exit plan is. My view is people can get in and out of the stock as they see fit based on liquidity. So there'll be no sale anytime soon.
Mm-hmm. Mm-hmm. I'm going to go back to some of the stuff we were talking about earlier. Define the typical seller of a business. Like we've always liked businesses where there's a lot of mom and pop, a lot of sort of maybe in some cases a succession issue. But what does the typical seller look like to you guys?
Yeah, it's exactly that. So it's usually a female that started the business, and she's looking for a succession plan. She's built a business. She's owned it for 10 or 15 years. She's at the point where she's looking to retire. And quite honestly, maybe half is too big a number, but a few of the sellers have sold to us and then gone to Florida right away for the end of the year because there's no personal tax to pay. So that tends to be a bit of a common theme. But yeah, it's just someone that started the business on their own. They did it for personal reasons. Usually, they're at the point where they're looking to retire, and we think we can provide a good solution for the staff that remain. That's key to us. We don't, people say, well, what happens to the business? The owner goes, it's going to deteriorate. And that's really not true. We don't want the owner to stay. Like we have a certain way to do business. We have a certain, growth that we want to achieve in mind. And usually the owners are quite happy with what they have. And so we're very happy for the owners to leave, but we do want the office staff. That's key to us. And usually within the office staff, there's a nurse, like a registered nurse or an LPN, or someone with a geriatric care background. So that's absolutely key to us.
And then typically, how do you find these deals? Like, how do they come to you?
Yeah, so we're well known, particularly in the U.S. as a buyer of these private duty or private pay businesses. Like we've been sort of profiled in some major, sort of newsletters. I don't mean investment newsletters, but sort of industry profiles. And so we get calls from business brokers all the time. And there's sort of a select few business brokers that or investment bankers that sort of focus in this space. And so again, we're a good buyer. We bring a professional type of program, right? We have the same letter of intent, the same due diligence. We actually have a team that can go in and do it, the same process, the same banker, the same lawyer. And so the feedback we get from the brokers is that, do I deal with an individual or deal with you guys that have a whole, sort of team and support behind you? So it's an easy decision. So business brokers are one. A couple of major conferences we go to. We have a direct outreach program. So we'll reach out directly, and that usually leads to opportunities. One of the ones in Nova Scotia closed on last year was a direct outreach I did. And then the sellers that we purchase business from typically have had a good experience, and so they'll refer people within their peer network. And so I think those are sort of the four main ways in which we attract new opportunities.
Okay, great. We must be doing a great job because we're not getting any questions from any of the listeners, so that's a good sign. I guess coverage. Tell us a little bit if there's anybody covering you guys. I mean, you're still very small. Anybody of note that is kind of watching you guys?
No, we don't have coverage at this point, nor do we have an IR firm. Two things that people ask me about now and then. I've sort of liked to build this organically. Who knows when that'll change, but we've had discussions with folks, but no coverage, nothing official at this point. I think the support we've gotten in the markets has typically been around, some of the retail shops that we work with that like our story and put their clients in the deals. So no, the answer is no at this point in terms of coverage.
Perfect.
We're very much under the radar.
Yes. Perfect. Trevor, do you any other questions, Trev?
Yeah, I mean, a little bit of an obscure one, but you guys actually, from your financial statements and your MD&A in your disclosure, you guys have removed the going concern clause, sort of, I guess stating your financial position that you're in. What was the conversation like with some of your board members and team, around that, and what was that like?
Pretty straightforward. I mean, it's really a discussion with the auditors, right? I mean, it's we've had the going concern note since we started as a startup, obviously for valid reasons. We're at the point where, you take a look at our EBITDA trend, our revenue trend, our operating cash flow trend, the fact that we've raised money in the markets when we've needed to. We have a major Canadian bank that helps finance us and supports us. We don't actually have any, bank covenants other than the requirement to pay back our interest and principal on a monthly basis, and obviously reporting requirements. And so we're in really good shape so I think that, you kind of take a look at the trend, right? I mean, before it was certainly appropriate for us to have a going concern note because, I mean, let's face it, you're an early startup company and we hadn't demonstrated, cash flow positive, at that point or positive EBITDA. But as those things have come along and we've demonstrated continuous performance quarter over quarter, it just made sense to do it. And so Obviously the auditors do the work they have to do, but it really wasn't a big discussion.
Okay. Okay. And
so obviously we're not doing a perfect job because we did get a question here. What keeps you up at night? What's your biggest concern running this business?
I mean, at this point, it's COVID, right? I mean, it's funny because I do get that question a lot. And so before this, I would say, well, I don't stay up at night. I sleep actually quite well. That's always been my answer, because it's true. And I still sleep through the night. Don't get me wrong, but obviously, this is an uncertain time. We're going through a pandemic. I never thought of a pandemic-proof company, but now I do think of pandemic-proof companies that are out there. Again, we're fortunate where we are, right? I think about, everybody's healthy, whether my family or staff, everybody has jobs, they're able to work, which leads to a different type of health. But it's really, it's really the safety of our clients and our staff. And that's been our priority. The decisions that we make are driven by that. Right. So, during this time, if hours go up or they go down, revenue goes up or down, I'm quite honestly not overly concerned either way. I am concerned about the safety of our clients, given that we're dealing with and staff, given that we're in the middle of a pandemic. And so, that is the absolute priority at this point.
Mm-hmm. And then I got one more question here too, as well, Chris. Just touching back in on the KPIs that you guys are after internally. You talked about an ROIC, number, and what kind of number is that, or what kind of threshold are you guys looking at there?
Yeah, I don't think that's ever been released. So I probably maybe I'll touch on that in a future press release.
Okay. And then as far as, your accounting background, very strong, and, numbers oriented guy, like from an investor side, like what should we be thinking about, this business and really what we should be looking for moving forward?
Yeah, I don't think I'm a good accountant, but I do think I am good at numbers. I appreciate the comment, but here's my view, right? And take it for what it's worth. I believe in a decentralized model, right? I very much believe in giving opportunity internally to staff. We've done that, and so I believe in testing our people. And you think about a time like this where I used to work at a bank, right? And so you come through a time like this, the first thing to do is send out an email and say, we got to cut, right? We got to cut staff. What else can we cut? We got to cut expenses. Well, we already operate on a fairly lean basis. The decisions that we made a year ago are great for us now because we're not scrambling trying to cut all these different things out of our business, right? I mean, I'm not traveling as much, so I don't have airfare and some of the stuff I'm doing virtually, obviously. But we're not a fat company, so I think that's important because I think our money goes a long way. If I could just take you sort of back to the acquisitions that we're doing, I think if you were to take a look back at how much cash Nova Leap put into the deals over the last couple of years, I think it averaged about 29%, right? So we were putting about 30% into the deals. The rest were financed either by the bank, promissory note, or earnout. So our dollars are going a long way, right? Which again speaks to the fact we haven't had to raise money for 14 months. So again, if you're an investor, I think what I'd be paying attention to is just, I think, how well we manage our business, at least to date, right? I think we've done a good job demonstrating we can improve the performance of the underlying companies, and I have no reason to believe that that's going to change going forward.
You know what? There's one last question I'll give you, and it's from Jennifer here. She's just asking the mechanics of how you guys actually operate. She wanted to know if your workers, your healthcare workers, or your employees, do they see more than one client a day? Obviously the social distancing issues and people potentially transmitting. How many people do your caregivers give care to in a day?
It depends on the situation. The answer is yes. Do we have some caregivers that see more than one client a day? Yeah, absolutely. What we did do, though, we did this early, is we separated any crossover between facilities and the home, right? And so I made sure that all of the agencies were, if you had a caregiver, then you can provide work in a facility. That's what we wanted. but you can't go back between facility and a home. And I think that's served us very, very well. But yeah, sure, we would certainly have caregivers that would provide, again, care to more than one client in the home settings, but not crossing back and forth.
Okay, perfect. I think we'll leave it at that. I think we've done a pretty good job of understanding the business. Chris, I mean, I personally want to thank you and your business. I know in these times, caregivers, obviously they're being put under a lot more stress and put in harm's way a lot more than us staying at home. So I really want to thank you on behalf of us and really appreciate the work that you and your team are doing. So thank you, and certainly thank you for the time today. And appreciate the opportunity to get to know the business a little bit better. I think you guys are in a pretty strong position as far as where healthcare dollars are going to continue to flow over the next little while. So again, appreciate all the time. And Trev, if there's anything you want to say, I'll give you the last word here and let you sign off.
Yeah, no, same, I echo what Paul says. Thanks very much for your time, and, looking forward to the upcoming results you guys have, and just waiting for the numbers to sort of speak for themselves, which they're starting to do right now. So exciting times for you guys, and we'll continue to follow the trends here.
Yeah, thanks a lot, guys. I appreciate take the time to have me on today. It's great to be able to share the story. So I appreciate what you guys are doing, and stay safe out there.
You too. Thank you.
Thanks a lot, guys.
All right, take care.
Bye-bye.